A question I've been getting a lot lately is about when this bear market is going to end, which is a good question because obviously everyone is tired of Mr. Market just stabbing them in the face over and over again. Even as I'm recording this right now, we got a little pop in the market only for it to turn around and head lower again. Surprise, surprise. Someone needs to give Mr. Market some Viagra or Cialis or something just so he could stay up. So of course all of us are having a real hard time with this, but Mrs. Market, she's having a real soft time. Which brings us to the first question we got to ask about this market is whether we're going to have a hard or soft landing, because that is one determinant for how long this bear market will be and how bad it will be. So just to review the difference between a hard and a soft landing, a hard landing would be the Fed raising interest rates so high to fight inflation that it pushes us into a recession. A soft landing, on the other hand, would see the Fed raising rates just high enough to bring down inflation, but not so much that it causes an economic contraction. And by the way, for this video, we're going to use some more data from Ben Carlson. This guy makes my life easy. He just puts all the data together for me. Now, if you remember the video we did recently with Stan Druckenmiller, we talked about how the chances of a soft landing are very, very low. And the reason why is because if you look at the data, all the other times when inflation was over 5%, we usually got that hard landing. And in this case, as Druckenmiller talked about, and he's the legendary macro wizard investor who's just the best, like the greatest of all time. He also talked about how the Fed is so far behind the curve in terms of taming inflation, because our interest rates are here, right? But inflation is here already. For them to go and fill this gap and actually get interest rates high enough so that inflation is under control, that's going to be a fast and brutal raise of interest rates, which is going to push us into a recession. So in Druckenmiller's view, we were going to hit that recession in 2023. And I know a lot of you have commented on previous videos like, aren't we already in a recession? 2 quarters of negative growth, right? Or whatever the official definition is. And yeah, could be true and it could get worse. But at this point, whether you consider us in a recession already or not, the odds are in favor of, yes, the recession coming. So that's the first factor we got to understand. We're going to assume no soft landing. We're going to have a hard landing. We're going to be in a recession. So then we could look at the data of recessionary bear markets, like what happens to the stock market during a recession. Well, surprise, surprise, the biggest crashes in history have been caused by recessions. And we're talking about crashes, we're talking about stock market crashes. And this obviously makes sense when you consider that people lose their jobs during a recession, companies go out of business, and people lose money and stop spending as much. So of course that's going to have more of a negative effect on not only the economy, but the stock market. It doesn't take a genius to figure out why the stock market tends to fall a lot during a collapse in economic growth, which is what we would have during a recession. But we've also had bear markets that occur outside of a recession. A recession is not a prerequisite. We've had 11 of them in the past 90 years. And you can see here the 2 types of bear markets. We've had 14 in recessionary periods and 11 in non-recessionary periods. 14, the drawdown is closer to 40%. With the recessionary 14 of them, the drawdown is closer to 39% or 40%. And in the non-recessionary, it's lighter. It's around 25%. And the recessionary ones also have a longer period. They're closer to 400 days from the peak to the trough, meaning from the top to the bottom of the market, versus non-recessionary, which is 202 days. So it's like half the time. So the obvious takeaway here is that bear markets that occur outside of a recession tend to be shallower and less lengthy, while the recessionary bears are greater in both magnitude and time. So if you think the Fed can keep us from going into a recession, we may be closer to the end of this current bear market than the beginning. But if you think the Fed has no chance of sidestepping a slowdown and we're going to get a hard landing, then there's going to be more pain ahead. And what did we say? We pretty much think that we're going to get a hard landing. At least that's what the odds favor. You never know what's going to happen. All you could do is play the odds. Now, it's worth mentioning that not every recession in history leads to a bone-shattering crash. The bear markets in all these years were all losses of less than 30%. So it is indeed possible to have a recession that leads to a relatively minor bear market. So again, we don't know for sure what's going to happen. That's the theme every time we talk about markets. I say that in every video, and a lot of you get mad. Actually, I shouldn't say a lot of you, because the ones that get mad, you're not watching anymore, are you? But don't get mad at me. I'm just the messenger. The market is going to do what it wants to do, right? That's why this channel is called Fallible. All we can do is take the information that's coming in and change our thesis of what's going on. And then, of course, manage our risk and trade and invest accordingly. Trying to actually predict the market, though, and put a stake in the ground, well, that makes you an idiot. Because all you could do is play the probabilities. And Ben says the same thing here. He says, regardless of how things shake out in the economy, the one thing no one can predict is the action of investors. Because we saw that run up in prices following the pandemic crash, right? It was a massive move. And now what we could get is the pendulum swinging too far in the other direction if investors really panic. And you can check out, like we've been tracking this market, right? The sentiment and positioning gets worse and worse as we continue to head lower. And that's why these previous 2 points here we thought were potential bottoms, because because of how bad the sentiment and positioning is. And again, potential bottoms, right? Potential meaning that we might put on some starter positions with the idea that, hey, we might get stopped out. You got to be careful, right? And sure enough, our first call turned around. Second call, it looks like it's turning around again. And that's fine because of our position sizing and risk management. We're not getting hurt by that. And it serves as a reminder that, again, you don't know what's actually going to happen. That's why you have the risk management in place too. You got to prepare to be wrong because you're going to be wrong a lot. And that's okay. It's fine being wrong in the market because guess what? You could just turn around and play it the other way. The only time you get screwed up by being wrong in the market is when you stick to it and you put your ego in it and you start saying, I'm not wrong, the market is wrong. But no, Mr. Market is never wrong. Only when he's talking to Mrs. Market, then he's always wrong. So in reality, the hardest part about bear markets is that no one really knows when they're going to come to an end. But the good news is that they do always come to an end at some point. You just have to be patient to see how this one plays out. Now, a deeper way we could look at it is how long do stocks take to bottom in a bear market? So we can look at every bear market here from peak to trough. We can look at the decline, percent decline, and how many months it took from the top to the bottom, and then how many months it took to break even once again after that. And you'll see here, if you just look at these numbers, it takes a long time to get back to break even after the market stopped falling. And one of the reasons for that is because we know how percentages work, right? If the stock market falls 10%, it takes more than 10% to get back to break even. It takes like 11.11%. And that's because, again, percentages, when you're starting from a lower base, it's going to be a higher percentage to get back to where it was. If you don't believe me, just look at a calculator, I guess. So if we take the averages of all these bear markets and keep in mind there is a big variance between them, like you got a 50% decline in 73, only 20% in 48. But if you take the average, the peak to trough in terms of months is 12 months, so about a year. So the average bear market would last about a year. In our case with this bear market right now, I'd say we're 6 months in, 7 months in. Maybe it'll hit a bottom by the end of the year. But then after that, it takes nearly 2 more years to break even. Now, of course, some are longer than that and some are shorter. Now, here's the thing during the break even period. If you're a buy and hold investor, yeah, it's going to take 2 years to break even. If you're more of an active investor, like we are here at Fallible and Macro Ops, then it'll take less than that. In fact, in our Macro Ops portfolio, we're up 20% right now, while the market's down 30, or I guess it's down less than 30 now, but it's heading back there. So active investing is good in these times. But here's another way to look at it. How much longer do bear markets last once stocks are already down 20%? Because we have a ton of variance here, right? So let's say if this current bear market lasted until 2023, and then it took 2 more years to break even, that'd be what, 2025? And then we'd be breaking new highs in the indices? There is potential there, but there's also these nasty periods, like in 2000, it took 4 years to get back to break even, 48 months. But anyway, okay, if we look at what stocks do once they're already down 20%, well, in our best case scenarios, when we look at all the bear markets, the best one would be kind of like 48 and 49 or 57. So the downturns hit 20% losses and immediately bottomed. So where are we right now? We're right above 20%. And at our lows, we were almost at 25%. So best case scenario, we would bottom right around here. So say like we're heading down right now, right? If we don't make a lower low, if we just make a higher low or even a low right, where the previous low was, that would be a good sign. That'd be maybe bottoming action happening. You don't know for sure, but it may be happening. I doubt it. But maybe. And I doubt it because inflation still isn't under control. We got some ways to go. But anyway, best case scenario, we would bottom right there. Now the good news is that 7 out of the last 12 bear markets have bottomed in 46 days or less once this 20% level was breached. So about another month and a half maybe for 7 out of the 12. And 5 out of the 12 are over in a month or less. So 30 days or less. That would be just fine, right? That'd be great. Now the other side would be like 73 and 74, which took 10 months to bottom once the bear took hold at 20%. Because that's the official marking, right? To know that we're in a bear market. Or the 2000-2002 crash, which took nearly 19 months until we hit the bottom. And 2009 was 8 months later. Those are brutal. Again, you could pick whichever stats makes you feel better. We really don't know what's going to happen. But again, looking at our current market, say we're 23% down right now, which I think that's right around where we are. This means the market would have to rise 30% to break even. Now, what does that mean from where we are? Well, if it took 2 years to make up that lost ground, that would be annualized returns of 14% a year. Not bad. We like that, right? If it took 3 years, it'd be 9% annual returns. That's, again, not bad. And really, for 14%, I should have said it's really good, but we all have recency bias, right? We want like 30, 40% years, because that's what's normal after the pandemic or even pre-pandemic. It's stupid to think like that. because there is a long-term average. Now, if we hit the average bear market of the past 80 years or so and ended up down 33%, that would be a 50% return to break even. And remember, we talked about the percentages before. If you don't believe me, whip out that calculator. The bigger the loss, the bigger the gain needed to make it back. And a 50% return in 2 years would be 22% a year. Hey, that's great. 3 years would be 14% annualized, also good. Even if it took 4 years, that's still 11% returns per year. Not bad, right? And if you're an active trader, it can be much, much better than that. Now, again, we don't know how much longer this bear market will last, but if we look at the average data, we could say maybe 6 months more and then 2 more years until we get to break even. But once again, like we talked about in that Druckenmiller video, this current scenario with the high inflation, the low interest rates, the war coming off a pandemic, supply chain issues, all this hot labor market, there's so many factors, and we haven't had an analog like this before. So if we say this time will be different, that might be actually true. So we don't know how it's going to play out. But the best thing to probably imagine at this point is that it is going to be long term. And what do you do in a long-term bear market? You hold tight. In fact, go outside. Don't stare at the market the entire time. Because even if the economic world is crashing around you, guess what? The sun is still shining until it shines too bright and burns up the planet. But don't think about that either. Just go get a tan and wear sunscreen if you don't have enough melanin like I do. Even I wear sunscreen. But now I'm just giving you random advice. But the point is, just buckle in and keep your mental game strong. At the end of the day, these are all just numbers on a computer with fiat money. It's not even real. And the majority of you guys watching these videos, I know what type of financial state you're in, and you're fine. You have food on the table. You have a roof over your head. Don't stress too much about this stuff, especially when it always works out at the end, at least long term. So feel free to educate yourself, learn more, join the Macro Ops Collective. We got a bunch of stuff going on over there, but don't get depressed, don't get stressed out. And if you do want to go deeper into what type of bear market we're having, check out this Druckenmiller video right here, because he gave a pretty good explanation of what's happening here. And you know, he's the GOAT, he has 30 years of experience, pretty good. So click this video right here and I will see you there.